You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. I'm Susie.
And I'm Miro.
And today is Tuesday, January 27th, 2026. We are looking at the heavy machinery of the aerospace world, RTX. And honestly, for a company that usually moves like a cruise ship, this quarter felt surprisingly agile.
Agile? That's a generous word for a defense contractor, but I see your point.
Well, they beat on top and bottom lines. Sales are up 8% quarter over quarter to $24.2 billion.
Yeah. Look, the headline is clean. Adjusted EPS came in at $1.55, but you're right. The vibe shift matters more. If you watched the tape today, it was fascinating. Pre-market was hot, then the bell rings, and it immediately flushes down to $1.96. Everyone panicked for about an hour.
Right. I saw that. I went to get coffee and came back, and it was red.
Classic morning fake out, but then the buyer stepped in. It ground higher all day, clawed back every cent of those losses, and closed just over 201, up almost 1%. That's price action telling you the smart money bought the dip. They looked past the noise and saw the cash flow.
Which we definitely need to talk about. But first, just a quick reminder for everyone listening that Miro and I are just two friends looking at numbers. This isn't financial advice. We're not your advisors. Please do your own research before you buy any rocket ships.
Or jet engines. Definitely don't buy jet engines without doing due diligence.
Exactly. Okay, so Miro, the number that blew my mind wasn't the revenue. It was the backlog. $268 billion?
It's a fortress. They added $17 billion to the backlog in 90 days. Think about that velocity. A book-to-bill of 1.56 for the year. Basically, for every dollar of stuff they shipped out the door, they took orders for $1.50. They have insulated themselves from demand shock for, well, years.
But here's the tension I want to poke at. They have this massive backlog, but they've been plagued by the GTF engine issues, the recall, the powder metal defects. I saw they paid out $1 billion in cash just in Q4 to airlines for compensation.
$1 billion. With a B, correct.
That sounds catastrophic.
You'd think so, but here's the magic trick. Despite writing a check for $1 billion to angry airlines, they still generated $3.2 billion in free cash flow for the quarter.
Wait, that's after the payout?
That is after the payout. And that, right there, is the thesis. The legacy portfolio, the spare parts, the Collins aerospace stuff, the boring defense contracts, it's such a cash machine that it can swallow $1 billion penalty and barely burp.
That is actually wild. It's like they're printing money faster than they can accidentally burn it.
Roughly, yes. And finally, we have to mention Raytheon, the defense segment. For the last year, the narrative has been supply chain hell. We can't get the parts. We can't make the missiles.
Right. The industrial base is broken story.
Well, Raytheon segment sales jumped 10% from the third quarter, and Chris Collio, the CEO, explicitly said munitions output ramped 20%. So the stuff is actually leaving the factory now. The ramp is real.
So the excuses are running out, but the deliveries are finally picking up.
Yes.
Feels like a pivot point.
It does. But, you know me. I found a few things in the footnotes that make me twitch. It's not all clean.
Of course you did. You can never just let them have a win, can you?
Deadpan. Optimism is expensive, Susie. I prefer accuracy.
All right, well, grab your magnifying glass. Let's get into the details.
Okay, so remember how I said it wasn't clean? Here's exactly what I mean. Everyone is looking at that Pratt & Whitney margin, 8.1%, and saying, it's flat. But if you look at the footnotes, they took a massive hit, a $157 million charge because a customer went bankrupt.
A customer? Like an airline?
Presumably. They didn't name names, which is, standard. But think about that. $157 million just vanished because someone couldn't pay their bills. If you add that back in, Pratt's margins would have looked spectacular, especially with all those spare parts flying out the door. So the underlying business is actually running much hotter than the headline shows.
That's fascinating. It's like running a marathon with a rock in your shoe, but still finishing with a decent time. You don't realize how fast the runner actually is until they take the shoe off.
Sure, let's go with the rock metaphor. But then you look at the other side of the house, Raytheon, the missile guys. They reported this nice profit bump, right? But a huge chunk of it, $102 million, came from, and I quote, restarting work under certain contracts with a Middle East customer.
Restarting work? What does that even mean? Was it paused?
It's the Middle East, Susie. Things get paused. Geopolitics, funding, who knows? But suddenly the light turns green and boom, $100 million of profit drops into the quarter that wasn't there before. So you have Pratt losing money on a bankruptcy and Raytheon finding money in a restart. It's messy. It makes it really hard to model the normal run rate.
So one pocket has a hole in it and the other pocket found a winning lottery ticket.
Exactly. And that's why I don't trust the EPS beat entirely. It's lumpy. But there is one number that I think is genuinely impressive and also terrifying. We talked about cash flow being strong, right? $3.2 billion free cash flow.
Yeah, which is huge considering the engine payouts.
Right. But listen to this. The CFO dropped a little nugget in the call. That cash flow number included a $600 million hit from tariff-related impacts.
$600 million just on tariffs?
$600 million. Real cash, out the door. We always talk about trade wars and geopolitics as these abstract risks, right? Oh, there might be friction. Well, here is the price tag. RTX is basically paying a geopolitics tax of $500 million a quarter right now, and they still generated $3 billion in cash.
That is... Honestly, that changes how I see the whole quarter, because if that tariff situation ever normalizes, or if the engine payments stop in 2026, this thing is going to be a cash cannon.
A cash cannon? Let's go with that. But yeah, that's the bull case. The machine is inefficient. It's leaking cash to airlines. It's paying tariffs. It's dealing with bankruptcies. And it's still spitting out $3 billion in 90 days. Imagine if they actually fixed the plumbing.
If. That is a very big if with a conglomerate this size. So basically, they are winning by brute force, not precision.
Brute force is an underrated strategy in defense. But I do worry about one thing looking forward. They're talking about 2026 like it's going to be this smooth sailing recovery. But frankly, with that much manufacturing ramp still ahead of them, I don't know.
So yeah, let's step back for a second and think about what all this means going forward.
Look, the backlog is great, but backlog doesn't pay the electric bill. Deliveries do, and that's where my hesitation comes in for 2026.
Because they actually have to build all this stuff now. It's not just ink on paper anymore.
Precisely. To hit that $93 billion sales guidance, they are hiking CapEx to over $3 billion next year. That is a lot of concrete. They are literally building new factories, expanding capacity for what they call the Golden Dome programs.
Golden Dome. That honestly sounds like a James Bond villain project.
Or national security. But yeah, the filings actually reference an Iron Dome for America initiative. That is not a small project. That is massive industrial plumbing.
So the theme for next year isn't sales, it's execution. Can they actually get the metal out the door without tripping over their own shoelaces?
That is the bet. And don't forget, the engine headache isn't fully cured. They still expect another $700 million in cash outflows for the GTF issue in 2026.
Ouch. So the billion-dollar check wasn't the final one.
It was the biggest one, but the tail is long. Short pause. Basically, the easy money is gone. Now they have to execute on a timeline that has zero margin for error. If they miss on delivery, that $200 billion backlog becomes an anchor, not an asset.
It feels like they're a proxy for the whole world right now, doesn't it? Messy, expensive, a little dangerous, but ultimately indispensable?
That is, actually a perfect summary. It is defense as a utility. You hate paying the bill, but you really need the lights to stay on.
Defense as a utility. I think we just found the episode title.
I'll invoice marketing.
All right, I think that puts a bow on it. The machine is heavy, but it's moving.
Slowly but surely.
And that is all we have for RTX. Stick around for a quick note on how we made this episode. Short pause. So, just a moment of transparency before we go. What you just listened to, Earnings Unscripted, is actually an experiment.
A frontier we are all exploring together.
Exactly. This episode was created entirely by a team of AI agents, from the research analyst digging through the 8Ks and transcripts, to the scriptwriter crafting our banter, to a fact-checking QA specialist, and finally, to the voices you are hearing right now. It's all working together to deliver high-quality, up-to-date information that would hardly be possible otherwise.
And hopefully to make it sound a little less robotic than your average spreadsheet.
That is the goal. We really want to know what you think. Is this valuable? Does it feel right? If you have questions or comments, please reach out at earningsunscripted@datamadness.ca or follow us on X.
See you after the next call.